Imagine you work hard, save up $10,000 in cash, and stuff it right under your mattress for 10 years. When you pull it out a decade later, not a single physical bill is missing. The number is exactly the same. But that stack of cash can only buy you about $7,400 worth of stuff. That silent, invisible decay of your money's value is inflation. Money simply buys less over time. The U.S. government measures this decay using the Consumer Price Index, or CPI. They track a massive basket of everyday goods, like rent, gas, and the groceries you see here on these shelves, to monitor exactly how fast those prices are going up. Central banks typically target a steady inflation rate of around 2%. You probably think you won't lose a single dime, right? This chart shows the actual math behind that strategy. If your standard savings account pays you 0.5% in interest, but normal inflation is running at 3%, you are taking a net loss of 2.5% every single year. We call this purchasing power erosion. The number on your bank screen technically goes up, but the amount of physical goods you can afford to buy with that balance is slowly going down. Parking money in a regular bank account guarantees a slow, mathematical loss of purchasing power. To figure out how to protect your wealth, we need to look at the purchasing power spectrum. This is a way to rank investments by how well they handle rising prices. At the absolute bottom are defenseless assets. This includes traditional cash accounts and fixed-rate bonds. Because their interest payments are locked in, a spike in the cost of living simply crushes their real value. Move one step up and you find adaptive assets. The U.S. government designed specific tools to solve this problem, like Treasury inflation-protected securities and the Series I savings bonds you see here. The interest rates on these bonds are mathematically linked to the CPI, causing the yield to adjust upward as inflation rises. They are fantastic for shielding the baseline value of your short-term savings. But keep in mind, adaptive assets only allow you to tie with inflation. They don't help you beat it. At the top of the spectrum are proactive assets. For most investors, that means broad market index funds, like the S&P 500. These assets sit at the top because of one defining characteristic: pricing power. When supply costs go up, massive corporations like Apple or McDonald's pass those expenses to the consumer by raising the price of an iPhone or a Big Mac. This line graph shows exactly how that plays out over time. Because corporate revenues naturally swell alongside inflation, the S&P 500 has historically averaged around a 10% annual return. Look at this expanding wedge between the market's growth and the lower inflation line. That is your real inflation-adjusted wealth growing. By owning a piece of the companies driving the economy, you turn inflation from a threat into a long-term tailwind. We saw a massive real-world test of this dynamic between 2021 and 2022. As you can tell by these gas prices pushing well past $5 a gallon, U.S. inflation hit levels nobody had seen since the early 80s, peaking over 9%. The immediate fallout was brutal. As interest rates spiked to fight those rising prices, almost all asset classes suffered. The S&P 500 dropped 20% amid the panic on the trading floor. But look at the final outcome. Despite that severe drop, the S&P 500 fully recovered by 2024 and went right on to hit new all-time highs. Investors who panicked and pulled their money into cash took a double hit. They locked in their market losses right as inflation ate their dollars. But the people who held steady effectively spent that entire downturn buying premium assets at a steep discount. Trying to perfectly time your entry and exit from the market based on fluctuating inflation data is a proven losing strategy. So what steps should you take right now? Step 1. Relocate any idle cash from low-yield checking accounts into a high-yield savings account to slow the bleeding. Step 2. Look at your emergency fund, or any money you know you'll need in the next 5 years. Secure that cash in adaptive assets like I-bonds or TIPS. Step 3. Direct your long-term wealth into broad, diversified index funds like the S&P 500 to capture proactive growth. Inflation is an unavoidable long-term challenge, but consistent, diversified investing in the broader economy remains the most historically effective way to outpace it.